Greetings, welcome to Money and Banking. In this video, I'll try to give an overview of what the class is about. Uh, and I'll do that two ways. One, by talking about a specific issue that was maybe not in the news quite so much today, but was a big deal a few years ago. And I'll also give kind of a basic macro lecture and then talk about where money and banking fits into that. So, first sample issue, QE. So some of you probably know what this stands for. This is quantitative easing. So this was a policy that the Fed followed coming out of our last recession. So everybody knows the basic story. We had a housing bubble. The bubble popped, housing prices collapsed, and that led to a lot of knock-on problems in the financial system and the most severe recession we've had since the early 80s. Uh, so the usual story for how the Fed, the Federal Reserve, deals with a recession is to lower interest rates, which makes it easier for people to borrow, businesses to borrow, stimulates the economy, and helps us get out of the recession. This last recession was special in a number of ways. One of them was that the Fed's interest rate, they got it all the way down to zero, which is pretty much as far as they want to go. Uh, that's the ZLB is the zero lower bound. So we hit that. They still wanted to do more. They still wanted to give more of a boost to the economy. So they increased the money supply even above and beyond what they needed to do to adjust interest rates. So that's quantitative easing. So let me just show you some data quickly. Here's the money supply for the U.S. This is M1. There's a few different ways to measure the money supply. And this goes all the way back to 1980 up until today. And this is from the St. Louis Fed, which is a data source we'll use a lot. So you'll get familiar with this shortly. Now you can see quantitative easing right here. It's the money supply trends up, broadly speaking. But then this is the gray area here is that our last recession, 2008 to somewhere in the middle of 2009 was the actual recession when GDP was falling. We had since then there was a kind of slow, painful recovery. But you can even on this long, even over this time span, you can see quantitative easing. This big bump up in the money supply right here, and even later on, it seems to be growing faster than usual. We can use this to zoom in. If we really zoom in on that period of time, you can really see it. There were actually 3 rounds of quantitative easing. This was the first one, right in the middle of the recession, right? The financial crisis is happening. The Fed takes a number of actions that increase the money supply pretty quickly. All right. I went looking for a video of Ben Bernanke, who was the Fed chair at the time. I thought there'd be I could find some video of him explaining what he was doing. When I searched on YouTube for videos about quantitative easing, I found endless people talking about what a horrible idea it was and how terrible it was going to be for the economy. All right, so let's talk about what are the arguments for and against here. Well, the big ones, the Fed, like I said, their usual way to stimulate the economy is to try to stimulate lending. When they lower interest rates or give banks more money, that's more money that the banks can lend out, that businesses can expand, hire more people, and help us get out of a recession. What people were, they said it a lot of different ways, but really what it comes down to is inflation. Some people would say things about debasing the currency and make it sound fancy, but it's really, they're saying if you increase the money supply, then that's going to lead to an increase in prices, which means that the value of money is going down. And that's a problem. So now the next question is, what does this mean for us? This is all of this. If you don't, there's a lot of bodies buried under all of these arguments here. So that's what I'll talk about in a second. The argument here is pretty much over. Quantitative easing did not lead to inflation. It didn't lead to a whole lot of lending either. It's a little hard to judge this, but certainly the people that were predicting double-digit inflation, double-digit interest rates coming out of this were quite wrong. So whether quantitative easing helped or not is an open question, but it certainly didn't lead to the problems that some people forecast. All right. All right, so this slide is just a summary of what I said about quantitative easing, and what the idea was to try and stimulate the economy. So this brings up a lot of questions for us. If you don't understand every step along the way here, if this doesn't make complete sense, don't worry. That's what the class is about. So what do we need to nail down to really understand what's going on here? Well, what is the money supply? I just showed you M1, but there's actually multiple ways to measure the money supply. Another question, why does the Fed have any control over this? What exactly are they doing when they try to increase the money supply? What are they doing? Now, the usual story with monetary policy, when you turn on the news and hear about what the Fed is doing, what they're talking about is interest rates. So that's another question. What is this? Why do they have? What gives them power over the interest rates? Which interest rates do they control? There's lots of interest rates in the economy. So that's something else we'll have to understand. Interest rates, we need to understand the bond market, the market for corporate bonds, the government for government bonds. What makes interest rates go up? What makes them go down? What makes some interest rates higher than others? So the short answer for how the bank does this is they buy bonds on the open market, but really what's happening is there's money and bonds going back and forth between the Fed and banks. So we also need to talk about banks. This is a class of money and banking. So let's look at some balance sheets. And what are the decisions banks have to make on a day-to-day basis, and what are the decisions they make that connect the money supply and the broader economy? So the broad outline of the class is we're going to start with the micro issues and move towards the macro issues. That's one of the kind of nice things about this class. A lot of econ classes get stuck just talking about micro issues or just talking about macro issues. And we get to talk about a real wide range of things. So starting with money, just the question of, why do people hold money? There's lots of ways that you can store your wealth. What's the reason to hold money versus other assets? And a simple question will be, why hold money versus bonds? What's the relationship between bonds and interest rates? So we'll have to talk about supply and demand for bonds, supply and demand for money. Like I said, moving on to banks. What are banks thinking about when they make their lending decisions, when they make a decision to buy bonds? And to really understand that, we'll have to talk about banking as an industry and how the government regulates the banking industry. And finally, at the end of the class, we'll get back to monetary policy and what the Fed has to do with all of this and how that affects the broader economy. So another way to introduce how all this works, what's the role of money in banking, is to think about. Let's start with some macroeconomics. So if I was teaching an intermediate macroeconomics class, I would spend a good chunk of time looking at a flow chart like this. And this is just, a follow the money in the economy flow chart. So let's talk about this and then talk about where banks fit in. So there's two main players in the economy, there's households and there's businesses. And households get money from businesses through, say, wages. So people go to work for a company and they make wages, and that's part of the money that goes from businesses to households. It could also it's not just wages though. It could be profits. If you're a small business owner, then your income from the business is the profits of that business. And there's other kinds of compensation. A lot of people get their health insurance through their jobs, so that's other compensation money that comes from the business to the household. So that's all part of what we call national income. Households also turn around and buy stuff from businesses. So when you buy a car, that's money going from a household to a car company. So anytime we buy stuff, that's money going from the household sector to the business sector. We call that consumption. It's not the whole story, though. Not all the money coming from out of the business sector makes it over to the household sector. Some of this gets taken in taxes by the government. So when you see public sector, what that means is the government, the broadest version of government. Any institution that can take money in taxes. Some money comes back out in transfers, maybe Social Security, maybe welfare payments, anything like that is what we list under. Why we put transfers there. So after we take account taxes and transfers, then the money going into the household is what we call disposable income. Governments also buy stuff from businesses. If they buy computers or fighter jets, then that's money going from the government to the business sector. We're taking account of the rest of the world. There's exports and imports, but I won't worry too much about that. Now, the one part I haven't talked about yet is what's going on right here. All this money coming out of the household. So just to say that disposable income comes into the household, consumption comes out, that's not the whole story. Because households don't spend everything that they get. They save some. And that savings could take lots of forms. It could be a checking account. It could be retirement savings, money going into a retirement fund, or life insurance. So there's lots of ways to save, but all of that is money going into the financial sector. And the flow chart here says there's money coming out of the financial sector is investment. Now, this is a word we have to be very careful about, this word investment. So usually if you just grab somebody in the street and say, what does investment mean? They'd say, well, that's people buying stocks and bonds, to save for the future, try and make a return. But that's not what investment means here. That's more, what's going on, in the savings part of things. Investment here means business investment. So when businesses expand, build a new factory, somebody opens a restaurant, that's money coming out of here, and almost always that'll involve some kind of loan from the financial sector. So if you want to open a restaurant, you have to go to a bank and explain why the bank should give you a lot of money to build a restaurant. And so that money coming out of the financial sector, that turns into business spending. That's what's investment here. So the answer to the question, where does money and banking fit into this? It's all in here, all that green bubble there. So the role of money and banking in the broader economy is this connection between savings and investment. Some people have money that they don't want to use now, they want to use later. Some people have an idea or a business that needs money, and the financial sector connects those people. And how well a job it's doing is a big factor in how well an economy works. Okay, so this is what we just said about that flow chart. So here's this last part here. This the connection between savers and borrowers is the big role that financial markets play. And for us, we're going to be focusing on banks as that specific part of the financial market. Now, one thing that just this note down here is just saying that that flow chart isn't perfect. That if we are really taking everything into account, we'd recognize that there are some businesses that save. In fact, more and more these days, tech firms like Google and Apple, they have a lot of cash on hand, or they do a lot more savings than businesses did in the past. So that flow chart is not perfect, but it gives us a basic idea of what financial markets are there for. And the other question, along with all of this about when are financial markets working well, the effect on the economy, is now how does the government get involved? And the government in that flow chart was government's taxing and spending, but another big part of the government for us is the Federal Reserve. And the Federal Reserve regulates financial markets. They control the money supply, which has a big say in what the financial markets can and should do. So regulation is another big part of what we'll talk about here. So who are we talking about? Well, there's a famous face, Alan Greenspan, who was the Fed chair for before Bernanke, starting in 1987. Bernanke took over, I believe, in 2005, 2006. This is Hank Paulson, who a face you would have seen if you were following the news during the financial crisis. He was head of the Treasury Department. So that's the Treasury Department is the part of the government that handles borrowing and lending by the government. But he was also the person who who was in charge of organizing the bailout of Bear Stearns and the non-bailout of Lehman Brothers. He played a big role in, along with Ben Bernanke, who was chairman of the Fed at the time. So during the financial crisis, those were the two big players trying to get the crisis under control. Larry Summers, Treasury Department, followed Paulson as Obama's initial Treasury Secretary. Jack Lew took over after a few years. Janet Yellen is our current Fed chair. And our current Treasury Department chair is Steve Mnuchin, who was a head of Goldman Sachs for a long time, and is now under Treasury Secretary under Trump. All right, so the Fed and the Treasury Department are two big players in the regulation of financial markets. Also, the SEC, the Securities and Exchange Commission, Commodities Futures Trading Commission. These are big regulators when it comes to the stock market, asset markets. But probably more importantly for us is these last two here, the FDIC, the Federal Deposit Insurance Commission, and state bank regulators. These are more directly related to banks. So the FDIC was set up in the Great Depression to help deal with bank runs. If banks are always vulnerable to if a good chunk of their depositors withdraw money all at once, they're going to run out of reserves. And that was a problem in the Great Depression. So this is the FDIC has insurance against in case such a thing happens. Uh, and some banks are regulated by the Fed, some are regulated by their state bank institutions. So we'll get into that later. Another big topic, which it's hard for me to say a lot about now, is the Dodd-Frank legislation. Coming out of the financial crisis, Congress passed a big piece of legislation, 8,000 plus pages of reforms to uh, a lot of bank and financial market legislation. It was, and even at that, it left a lot up to the regulators to pound out the details. So Dodd-Frank is not fully implemented yet. And now that Trump is president, Trump has said he doesn't like Dodd-Frank and he wants to get rid of it, which nobody knows exactly what that means. We probably can't get rid of the whole thing, but certain important chunks of it might die. So this is all very much in flux right now. So it's hard for me to say anything definitive. All right, so let's talk about some quick examples of the role of financial markets. Whenever a bank or a financial market is involved, somebody's saving, somebody's borrowing, and the bank is what we call an intermediary, or it could be a stockbroker, could be the intermediary. Whatever financial market institution we're talking about, it is the intermediary. So let's just talk about some quick examples and think about, for both of these examples, think about who's doing the saving, who's doing the borrowing, who's doing the intermediation. So you might want to pause the video for a second, just think this over. So here the saver in this bank's lending to a restaurant situation is, well, whoever deposited money in the checking account, they're doing the saving. Obviously, whoever is opening the restaurant is doing the borrowing, and the bank is the intermediary. Pretty straightforward. Now, a retirement fund buys a corporation's bonds. Well, the borrower here is the corporation. When a corporation issues bonds, what they're doing is borrowing. The people that buy the bonds are giving them money, and the corporation is promising to pay them back slowly in the future. So the retirement fund is the intermediary, and whoever is planning for retirement is the saver here. And that could, how that money gets to the retirement fund can vary. Sometimes people have an individual retirement account, so they give the money directly to the retirement fund. Sometimes they have a retirement fund through work, so it's the business takes part of the pay from a worker and puts it in this retirement fund. One piece of basic vocabulary is direct versus indirect finance. Direct finance means there's no intermediary. So there's plenty of instances where there can be borrowing and lending without intermediaries. But often intermediaries can help, and that's something we'll want to figure out, is how do they help. But let's just think of some examples here. So let's say Joe buys a bond from the government. Is that direct or indirect? Well, that's direct. There's no intermediary involved there. The government is the borrower, Joe is the saver, and there's nobody else involved there. Jane buys stock in Ford online. Now, just you probably know, but when you buy stock, what that means is you become a part owner in a company. So Jane is going to have a small ownership stake when she owns that stock. And in this case, if she's buying it online, that means there's some kind of online broker involved. AOL or E-Trade or something like that. So that is indirect, and the intermediary is the online broker. So if IBM takes a loan, almost always there's going to be a bank involved there, so that's indirect. Derek takes a loan from George to buy a new car. Well, that's direct. There's no intermediary there. George tells Derek to get lost, so Derek goes to the money store. Okay, now the money store is the intermediary, so that's indirect. If you haven't heard of this, the money store is an example of what economists will call a non-bank bank. A traditional bank takes deposits and makes loans. Some place like the money store doesn't really take deposits. They only make loans. So they get their money from investors or from the owners, or they may borrow from another bank, but they don't take deposits. And typically, these are places like the money store they'll do payday loans or loans to high interest loans to people with bad credit. Ricky buys a plane ticket to Thailand with a credit card. That is indirect. Strictly speaking, it's the bank that issued the credit card is the intermediary there. Google makes an IPO. So you probably know what IPO stands for. That's an initial public offering. Now, this is something that in the past was done by what's called an investment bank. So an initial public offering is Google offering stock. So they're taking a chunk of themselves and selling it to raise money. And so it's the initial public offering is their initial sale of stock. And typically the investment bank, what they do is what's called underwriting. They'll do all the details of writing up the stock, the legal details behind that, and they'll also guarantee a price. So the investment bank will say we'll guarantee a minimum price for their stock, and then they can sell it to some of their favorite customers, favorite investors. What was interesting about what Google did, and this happened back, I believe, 2003, 2004, something like that. They actually made multiple investment banks bid for the right, and what that had the effect of is these investment banks had to raise this minimum price that they were going to sell the stock at because they were competing with each other. So that's the first time anybody had done that, and it hasn't. I don't believe it's happened a whole lot since then, but it's certainly an interesting idea, and at least the idea is good by Google. So in this case, the investment bank is the intermediary. Now I should say right off the bat here that in the past there was a pretty clean division between commercial banks and investment banks. So commercial banks do what we think of taking deposits, making loans. Investment banks do underwriting. These days the division is not so clean. A company like Bank of America obviously does a lot of commercial banking, but they also do a lot of it in underwriting, a lot of functions that were traditionally investment bank functions. So when we're going to discuss mostly commercial banking, but I just want you to know that a lot of the big banks that you know also do what was traditionally investment banking. In the next video, we'll talk a lot about the role banks play and why we need banks, and that'll go along with the some of the initial questions that you may have answered along with the introductory announcement. So that'll be the next one.